Sorry. Sheesh. Cool. Jesus, please. Hey everybody, welcome back to another stream. Just wanted to double check a few things. I'm assuming you all can hear me. At least I hope so. But yeah, we should be live. Cool. All right, so let's get down to business, and I guess we can try and talk about what happened recently in markets. Cool. So between last week's message and now, boy, oh boy, was it a lot of stuff to take in. I believe last week we spoke about the main two events of the jobs report coming out, as well as NVIDIA earnings as the main two things on tab for question. I feel as if I recently, personally, my sentiment in the market kind of switched from a tactical bull person to a tactically defensive or tactically bear, or bearish in the case, simply based off sentiment, not based off fundamentals or companies, earning less or having less income, but just off the mere fact that the sentiment has shifted from what we have seen in a very open and welcoming bull cycle into a very skeptical, questionable bull cycle. Like, all right, we've gone up so much. How much higher are we actually going? And all this is really going to just be built on NVIDIA earnings, and that's it. That's all we should care about in the markets. But as you guys know, I am very data-oriented, number-oriented individual. So I think I want to go through one of these reports that I came across, and I think that will kind of help understand that. But so I guess wrap up what happened last week or so on. I think it would be pretty situationally aware to just say volatility kicked in, and boy, oh boy, did it kick in. It was absolutely insane. From what we were, let me see, I'm just going to go to it real quick. If we just looked at NASDAQ or SPY, let's just get a quick peek at what the heck actually happened. Let me see if I can share my screen and show you. So just from this point of view, in this case, right, If we look at the charts on the weekly point of view, right? Like with the amount of news and the feelings and all the crazy stuff that came about, like you would think, like, let's check how much QQQ is down this month. 7%. We're basically down 7% this month, right? Not like insane, right? Like a bear market requires 25% for us to get bearish. So we still have a good ways to go before we say, oh, we're in a bear market, right? Like, so QQQ has to be down at 470s. 470, which is basically the tariff like high almost from where we currently are to ever say that we're in officially a bear market. We're not there yet. And in fact, we're not even like we're about a third, if that barely a third of the way there. So I just find that pretty interesting how like we cared so much about like this pullback right now. And the other thing I wanted to kind of maybe note was like this is this month, right? Where last month we closed on new highs. And if we were to also go look at the SPY, this guy's down about 3.9%, so just about 4%. So the SP 500 is not also in a bear market as well. But it seems as if we are. Russell 2000 down 4.25%, right? Like it feels as if we are. The sentiment feels as if we have gone into the R word, right? Everybody's concerned about XYZ, ABC, not because these companies aren't making money, because they're making money hand over fist. The video showed you guys what 65 billion in net income this last quarter. Like the money is still there. Sorry guys, I'm gonna be taking a bit probably a lot more water breaks than usual. I am sick right now, so just pushing through it to give you guys all the market news that's needed and so on. But I shall be here for not too long this evening as well. But we're here at 6:20 and we're talking through the markets as usual. So it just seems as if you look anywhere on the news cycle, is this AI a bubble? Is this the bubble? And then when you start to put these pieces together and say, well, a vast majority of the GDP growth of the United States is connected to AI. Is connected to the fact that we have this stronghold in this one sector, and our technology companies have been able to really take a hold on it and gain and garner from it, really. So as soon as that one sector goes into question, right, like obviously the entire market starts to come into question because nothing else is really growing. Nothing else is really growing, right? They've all been stifled by tariffs. Almost every sector has been stifled by tariffs. So really, how is it really growing? As well as, you know, the question on rates coming in. Is rates going to be able to save us? Like, can we get more cutting, right? Some people are saying that actually rates may not get cut now because the Fed may need to keep extra bullets in the chamber for later, for like tailwind effects as opposed to headwind effects. So now rates are kind of slowly becoming a more of a tailwind macro movement as opposed to a headwind macro movement, which is new in some way, shape, or form, right? Like how is it going to be shown down the line? I think that's the big question, or a huge question at least, right? So So I really think a lot of this is kind of overblown. And I've been short this past week for the most part. I've been able to grab a few wins. Wait a second. Did I? I'm gonna go check on it real quick. Sorry. Did I also outline with you all like the what trades I outline with that noise? Okay. I liked Google, right? Google definitely showed us. Yeah, because last week I talked about Google, showing how like Google's the most primed to find its way into probably being an $8 trillion company. And to be fair, I think it may reach a point where Google begins to outpace Nvidia and somehow surpasses them as the number one. Somewhere down the line, I don't know where that makes sense in the timeline, but if you were to simply just extract all of the several businesses that Google runs and manages, and also how they've been able to really benefit from this, you can very well see like how Google can probably grab from this. So we went over gold. That was the week before. That was the previous week before trade, actually. And then I went over, how that gold trade worked. Talked more about QQQ. I was short last week too, as well. For the most part, it just so happened that it kept hitting the price target over and over again. And we talked about CPUs and like depreciation schedules and Oracle, which you could probably talk a little bit more like now, but I don't want to get too crazy into it. We already addressed it, right? And then we talked about Google. I think somebody else asked me about Intel. I'm not too much of a fan of Intel. Intel's not really all that interesting. Then we talked about Merck. Oh, Merck. Oh man. Let's check Merck real quick. Merck, baby. Straight up killed it, my boy. Right? Talk about, I think the week before last, or on that same weekly call, I was like, yeah, things look good. We were at 92.92 on that Friday's close. We ended up at the highs of 100 plus, and we closed at 97. Great gains on this trade. A very undervalued company. We started to see some rotation, and that rotation was out of tech, right? People selling some of the names that they're up. Like I mentioned, people up here are going to be interested in selling some of these names because they're in it and they're up over 150 on their cost basis, over 150%. So why else wouldn't we see like tech down 7-8% roughly on the month so far, right? Like they're willing to trim some here. We're getting into the year end, do some early some light early trimming, a little bit into cost savings. What do they call it again? Tax loss harvesting, where people basically book losses on purpose so they can mitigate their tax liability for the end of the year, as well as some profit taking, right? People managing their books, closing off some of their books, doing some of those adjustments. And because of that, we saw a rotation into into biotech, into pharmaceuticals. Companies like Merck, other companies that I've also seen recently, some of my other friends have played as well. Eli Lilly, huge name, has been on a run and has been continuing to run. if I were to look at the sectors on the week, like healthcare up in a major way. Well, this is just Friday, that price action, just Friday. But because Friday did all of a sudden just turn really good. But heading into the close, not so much, right? At least heading into the close for the day. But Friday was a relatively strong day out of nowhere. I believe Trump's administration floated the idea of allowing NVIDIA to sell to China. That opens up a whole other market. I'd say that basically grows their $500 billion net revenue goal for next year into at least 650. $500 billion to at least 650. Because I don't see how. The only way I wouldn't see how this almost doubles that is if the CCP, the Chinese Political Party, or CPC, I believe is what it is. Basically, the government says all right, that's enough on the NVIDIA. Don't buy so much of those chips. Focus on something else. And it literally puts a blockade on them from buying those chips, which they've done before. So it's not like it's not news in a way. They've done it before. I also think I mentioned I liked how energy is currently getting set up right now. Super, super long 2-year plus coil of just sitting here in this price, getting tighter, right? This range that ultimately in the longer run, we could very well see 115 plus from here. So something to keep in mind as well. But yeah, Merck, and then Bitcoin. What else? I was talking about Google from the point of view of iron. So I guess, yeah, maybe we can take a look at iron and see what happened over there. But I know that they got mauled. Yeah. They didn't get the bounce that I was looking for sure. Because this week got mauled. But they were trying to hold this zone, this 45 zone. Didn't quite do it. Got, again, mauled. But that's basically what I was looking at in last week's focus on Google. Google showed out. And I always say this. When markets are weak and mad companies are getting beat up, we look for the winners. Look for the companies that are up 1.5% on the day. Why? And then try to figure out why are they up, right? Because them being up means two things. What is currently happening that's causing the overall push down in the market when you're seeing mad names down. I believe the S&P closed this week 88% names down this week. 400 and something names closed negative this week. Not Google. So when the market is down as a whole and you look to see who wins, look. Well, you're not seeing my fault. I'm covering it. Google was up 10% this week. What the hell? You'd have never known that if you just looked at tech. If you just looked at QQQ. Or, you know what I mean? Or even the Mag 7. Look at the Mag 7. Down 1%. Oh, that's on the month. Hold on. Let's see what the week is. 1.9 on the week. Right? You'd have never known that Google was up 10% on the week. What makes them so special? And I'd say, really, it's the TPU. That breaking news was insane. People are realizing it, and people are finally, coming along here on Google. I remember crying out about Google back in May, talking about how it was trading at 16 times earnings, and this is a great buy here at 170, 165. And I stacked as much chips as I possibly could down there, 165, 170, and I still don't think it's enough. I stacked so much chips down there, and I still don't think it's enough. But ultimately grateful for it. But like I said, when the entirety of the market is down, you have to look and say to yourself, like, okay, well, two things are happening here. One, there's divergence because the whole market is down, but this name. And it could be any name too, not just Google. But in this case, I'm talking about Google. So there needs to be a divergence in whatever contagion is causing the current price to go down. And then second, there's a positive underlying effect of what that company is doing elsewhere or external to the negative contagion. And in this case, Google basically showed that TPUs are real, tensor processing units, which, as somebody who's not really that technical, my understanding is essentially this. GPUs are great. Okay, so we say this. I read this somewhere on Twitter, actually. CPUs are a Swiss Army knife, right? It's good, generally good, or okay to good at about everything. You can ask it to compute this way. You can ask it to compute this way in several different directions, and it can do it. It can open the wine bottle. It can wedge out a knife. It can probably pick a door lock. It can do all these things in an okay way, right? And then GPUs require tons and tons of graphics and performance, and they can output tons of performance. And they're really strong in that way. And it's more of like, think of it like the axe, right? It can handle lots within a short period of time. And it can continually do it, and it'll provide pressure, or maybe even a mallet, like a huge hammer, a little Thor action, lots of power to it. It can manage lots of power. And lots of graphics can be placed to it. And then the TPU is built within Google's cloud. And that's the tensor processing unit, which basically is like if we were to look on a factory line somewhere and we were to essentially like find one drill that its precise importance on this drill, or the importance of this drill on the factory line, is to drill this specific hole right here. That's the one. That's the one that it needs to do every single time. This one. And it can do that consistently every time. And it's going to hit it. Same diameter, same everything. Every time, it's going to do it really efficient, and it's going to do it really well every single time. And that's all it needs to do. And that's what TPUs are doing. And because of that, because it's built in the Google Cloud, it's basically speeding up and also making a lot of Google's cloud AI infrastructure and other pieces just way more efficient just off that. And I believe I also read somewhere recently, Google, one of Google's like cloud team leaders basically said like, hey, we need to double our compute every 6 months to be able to keep up with demand. Which sounds so insane. but that's what was said, right? They need to double their compute every 6 months to be able to keep it with with demand. So basically what he's saying is, like, hey, we're looking for 1,000x in the next 5 years, basically. And it's kind of crazy for me just to sit here and continue to talk about Google, but I need to start finding bear cases for Google at this point, because it just looks too good. You know what I mean? Like it looks too good in a way. So I think that's a big important factor. But let's get into some more data here and kind of talk a little bit about markets as well. So we've got so this is from B of A equity derivatives global team. Because I live in the derivatives market. I'm mostly in stock options. Trade QQQ, probably has my most net volume. But I also trade a lot in individual names. And as you guys know, a lot of this like AI bubble talk or AI questionable talk has been really mostly aligned with Oracle. Oracle's debt to income ratio has been a trouble. And that's been something a lot of people have been watching. That's also why you've seen the name get beat up as much as it has, right? Like beat up real bad. So yeah, what I'm seeing on my end is like we're seeing, let's see, boom, boom, boom. I'm done with this piece. Right, and like oh, I got so much more data to share with you guys. All right, boom, we're gonna do, oh, I'm not sharing that. Okay, hold on. How do I just open it on here? I guess I'll share this too. So here's some of the data. So here's basically the breakdown of what was bought, what was sold. This is essentially what it's saying. It's saying macro products, indexes, and ETFs combined were modestly net bought on the week. So basically, there were more buys overall than there were shorts, driven by long buys and short covers, right? However, amid a sharp intraday market reversal that we saw on Thursday, U.S. listed ETF shorts increased by about 4.6%, and week over week, they were increased. And 7 month over month, they increased. So the fifth largest daily increase year to date, and one of the largest increases in the past 5 years, more in subsequent posts. So that's probably something externally. It's worth noting that 3 of the top 5 increases year to date occurred in early April around Liberation Day. So that's a pretty good note. Early April around Liberation Day basically tells us, if we were to now go back to by early April. Where does early April put us here? Early April puts us at the bottom, essentially, of the Liberation Day movement. So that's definitely something that's worth noting, right? Keeping that in mind. in terms of what the heck does this mean, right? Like, what the heck does that mean? By saying like that those are the last instances that we saw. Those are the last instances that we saw that the largest intraday, the sharp intraday reversal on Thursday, U.S. listed ETF shorts increased by 4.6 and 2.8 week over week and 7.5 month over month. Damn, I'm gonna start having memory issues again. All right, here we go. I gotta clear up some space because it's obviously creating a problem. And then single stocks collectively were net bought for the fifth straight week in the way. Week. Wow, I can't read. Jeez. They're collectively bought for the fifth straight week, just 0.7 standard deviations on 1 year, driven by long buys outpacing the short sales, 1.3 to 1. Sector flows continue to point to increased rotation. Rotation, everyone. I'm sorry, I know you guys can't see it because I'm in the way in the bottom corner, but I'll read it out for you. Sector flows continue to point to increased rotation, most notably into healthcare, materials, and consumer discretionary, out of infotech and staples this week. What? So the rotation of money. Hey, when this money comes out of tech, when you see all these names fall X amount of percent or whatever you've seen, is basically, right? Wrong thing, sorry. You seen these names come out of these things? This 2.8% that we saw this week, and then most notably, like really the 7% that we've seen this month. That is money coming out. And trust me, that money doesn't just go straight to cash all the time. In this case, maybe a sliver of it or a portion of it will go to cash. But I can promise you that money goes back to work somewhere else. Why? Because these CTAs, these hedge fund leaders, all these other systematic flows find better things to go put their money in, risk reward, immediately. Immediately. And it goes back to what I was mentioning earlier when I was saying, like, go back to the sector, just looking at percent. Just look, right? Let's just look at percent of all these sectors that we have here: energy, financials, technology, healthcare, utilities, consumer discretionary, consumer staples, industrials, communication sector, real estate, materials, biotech, right? All these sectors, which ones do you think did the best on the week? The same ones that were mentioned right here in this data report. Like, there's nothing to it. Like, we don't have to make a huge thing out of it. Healthcare and materials, consumer discretionary. I literally just showed you where healthcare did 2.1%, materials did 2.24%. Biotech did 2.48% on the week. While the rotation out, right, of tech only did 0.3% on the week, up. Or sorry, that's not even on the week. That's on the day. It's on Friday. That's what they bought. The sectors bought infotech. Sorry, they bought out of infotech and out of staples. Anyways. So So now if we were to keep going in on this, let's see what we got some more data that comes through. In contrast to healthcare, infotech was the most net sold sector on Thursday, on the week, and in November month to date, as hedge funds have net sold the sector in 5 of the last 6 weeks. Is this surprising? We've seen it. It's all gone down. This week's selling in tech was about a net of negative 0.9 standard deviation on the year, and was driven entirely by short sales, which far outpaced long buys of 4-1. Nearly all subsectors, sans comms equipment, were net sold, led by IT services, tech ETFs, semis and semi equipment, and tech hardware, all net sold. Yet while infotech stocks were net sold in the aggregate, it's worth noting that one Mag 7 names were collectively net bought on the week, driven by long buys. Okay, you got me. Who was the one out of the Mag 7 that was net bought this week? Which one? Can you guys tell me? Let me know. I need y'all in the comment right now. Drop in chat. Yo, chat. Yo, actually, I can say that now because I'm a streamer. Whatever. But yo, chat. Which Mag 7 this week was net bought? Which one? Do we know? Right? Do we know which one? Let me know. I mean, I could make a guess. I could make a guess. Y'all not active in chat today, huh? All right. That's cool. I'm gonna let y'all rock. Google. Duh. I don't even have to look that up, bro. I don't even want to look that up, bro. So which names? Let me. I think it's Mag 7 is Meta, Apple, Google, Tesla, NVIDIA. That's 5. Which ones am I missing? Did I say Amazon? Probably Amazon if I didn't already say it. I'm not remembering the rest of them. There's one more. I said in the video, right? I had this in the video. I'm going to make another watch list right now. Oh, my fault. Come on. Why do you think it's so long? Or I'm going to get... Bro. I got a China watch list also. Why is this thing moving so slow, bro? No, this is actually crazy. So you got Apple. Microsoft's probably the last one I didn't say. Microsoft, Google. I like the GL one. It just feels more fulfilling to me. Meta, Tesla, this bad boy, Tesla get beat up like every other day, man. It's crazy. Every time it's up, I feel like with Tesla, if it's up, it's gonna be up huge, and if it's down, it's gonna be down huge. And I don't know any way in between, and nor do I even know how to trade this more times than not. But hey, if you got this one down packed, shout out to you, bro. Actually, hit my line if you know how to trade Tesla consistently, because this thing is built. This thing is built weird. Okay, I can almost assure you that Google was the name that was net bought this week. Like, fully almost assure you. Everybody else got the brakes beat off of them. Meanwhile, Tesla is still up here chilling at $300 a share at all-time highs. Okay. Anyways, I digress. So that's that window. Let's see. What more data do we have? So we got healthcare was the most net bought sector on Thursday as well as on the week, plus 1.9 standard deviations, driven by long buys outpacing short sales 3-1. This week's money long buying in the U.S. healthcare is the largest in 5+ years, the largest net buying. What? In 5 years. Why are we so interested in healthcare right now? This is what got me like now I'm like super intrigued. Do I need to get back into Merck position? Like biotech and to a lesser extent healthcare equipment, supplies, pharmaceuticals were the most net bought subsectors, while healthcare providers and services and life science tools and services were the most net sold. Interesting. I think that's why we saw that maybe why we saw names like United Healthcare not really have a right United. Dang it! What the heck is the UNH? Yeah, they didn't really have a good week. I don't think they had a bad week, but it wasn't great. Like look, right? Like, you know what I mean? Like, they're still down from this, obviously, in a pretty dramatic way, but they didn't have a good week. So this also tells me something else. Like, they're buying up healthcare, but they're not buying the $290 billion healthcare provider. I'm intrigued. The highest buying spree in this sector and this subsector didn't get any love. What's happening in healthcare? I don't really understand the business dynamics of healthcare. Like enough to have an edge here, I believe. But this is really weird. I mean, but to be fair, but I have seen that biotech and healthcare has been severely underexposed for quite some time. Severely net, like barely bought, like nobody, you know what I mean? Like nobody's left for dead. Nobody cares to get exposure there, like all that. Right? So that may be why. Right? Nobody's like been able to really dial in on that and kind of actually get away with it or even want to be in there. So that's another thing. Interesting take. So I guess people are interested in buying healthcare now, more specifically biotech. So let's go with that, I guess. So Now, if we were to take that and then maybe look a little bit into some of the sectors of the total, the prime book for the cumulative U.S. net trading flow on the 5-day period and as well as the 20-day period, a ton of dead money a ton of money is leaving Staples in the last 5 days. They're out of Staples. What does that also tell you? Recession? R word? They're not positioned, or at least they're not currently positioned for the R word, right? Like they were already net negative on assets that would be I'm sorry, you guys can't see this one. This sector is Staples. I gotta figure out how to like show you guys the whole thing. Maybe if I share the whole screen, that may be better. Let me do that. Right? Here we go. Now you can see the whole thing. I hope you can at least. So yeah, all equities were net bought. All through this up, down, left, right, center stuff, we were net bought. So actually, if you ask me, I think the current rents that we saw was very conducive for the market. Very, very conducive. And that this 590 base that we've like recreated, which I was really focused on the 600 being the base, but it seems like the 590 roughly down here is really the new base per se. Like volatility, like it really should have been 600, but volatility took us to 590, 585 basically. Cool. Excuse me. Materials, healthcare, consumer discretionary. So not only are staples being sold out, but they're also the inverse product, the consumer discretionaries are being bought up at maybe not the same pace of comparable, but it's been spread out a little bit. So super interesting as well to look at it from this like sectorial point of view, right? But if we go back to this Bank of America report, with what I'm seeing, it says we highlighted that dip buyers would have a better entry point when CTAs sold, and that dynamic played out in dramatic fashion. Right, Thursday's violent reversal, despite Nvidia's strong earnings, came alongside a significant mechanical selling and left U.S. equity position much lighter. According to our models, Nasdaq 100 futures are now close to flat, while S&P 500 exposure is almost only modestly long. Roughly 100 billion in index futures could have come off during this pullback, concentrated in the U.S. benchmarks. Remaining CTA longs are mostly in Europe and Asia. Most of the unwind is now behind us. And the next phase depends on market direction. The weeks ahead could be pivotal, as CTAs have room to reaccumulate 100 billion quickly if the markets turn higher. Beyond that, both CTAs and vol control strategies could continue adding leverage. What does that say? Particularly if volatility declines, creating a mechanical tailwind that would support a year-end rally. Okay. I think sounds good to me. It really sounds like vol showed us how much more stressful it can be off just vol doing its own thing. And really going off from there. Another graph or data point that I found super interesting. Which one? I'm gonna try and pull it up here, maybe. So they're looking at some of these graphs are looking at NASDAQ 100 in the US, right? So we saw the CTA positioning, like commodity traders, basically, like worldwide traders. The long positioning fell off a cliff dramatically, but they didn't really pick up a lot of shorts. I just think that they exited the market back to cash. And that kind of goes back to, I believe, another point that I brought up sometime last week in the I want to say that was last week on stream. I think it was last week on stream. But if I come back to here and I talk about the market updates sheet that I have, where I share data continuously. Is it this one? No. This is another Bank of America report that I did share with everyone on 19th. Where are we? Where are we? Boom. Global Bank of America Global FMS average cash level is at 3.7%. That's the lowest percent it has ever been, basically. Like only a few times, like 2 or 3 times prior to this, has it ever been this low? Insane. Right? Investors are holding one of the lowest proportions of cash in modern history. The November B of A Global Fund Manager survey says that cash levels of 3.7% or lower has occurred 20 times since 2002. Oh, my fault. 3.20 times, not actually just 3 or 4. And every occasion, stocks fell and treasuries outperformed the following 1 to 3 months. So, I mean, Buffett's winning, it seems. Treasuries are going to outperform because they're sitting here in cash, and then probably more and more people put into cash. More and more people flying into cash reconfirms that not only that the asset will appreciate, but it makes the bond market much more competitive. So that means that to actually be able to be able to make people interested in that and yearning to buy more bonds, the actual yield on those bonds have to appreciate. They have to appreciate. Sorry, one second. So if I go get my bond book, right? If I go get my bond book and I see like what's going on here, so if I go to get my bond book in chapter 6 of the bond book from the McGraw-Hill, it really shows what's super unique about indexes about bonds and treasury bonds as a whole to this, right? So what I wanted to show you guys was this like graphics in here. I think it was that one I just saw, but I'm just make sure that it is the right one. Is it this one? It's not this. Okay, maybe it's not in here. Maybe I read it somewhere else. Where did I read it? Dang. Okay. I got to figure out that. I always have those moments where I'm like, I read it here, I think. And I'm trying to find it, and I don't know where I read it. All right. Anyways, for sake of time, I'll continue going on with this. Another, this also brings me to this one. I want to share this one. This one was so sick, right? So I kind of want to show you all the cumulative effect of like why data is so important in the markets, right? So I looked at this chart from Citi showing Citi on spend by sector, right? And basically saying the total spending in each sector has increased in off-price retailers, in tires, in cosmetic stores, in household appliance stores, and in optometry. So here's one thing. Out of all these growths, the major winner was obviously off-price retailers, right? The TJ Maxx's of the world, who else? Yeah, the TJ Maxx's of the world, what other brands would I put in that? I don't know why, but I just keep on thinking of TJ Maxx. This might help me out here. Jeez Louise, there's one with the navy blue brand, whatever. It's the off-brand retailers of the world, right? The people that go to wholesale, grab a bunch of these brands, they come back with Polo and they're selling Polo at 30% off, all that stuff, right? These guys are doing numbers. Like, look, if we just looked at this sector on the year, they're up 20. They're not high-flying names like when we saw Uklo go hit 170%. Like, okay, cool. But boy, oh boy, like, and they're going into their strongest season of the year, right? The Christmas shopping season. Like, these guys are up 24% on the year, and it's huge. And as they've seen the growth change versus last year by subsector, immense change. 20% on these, like, we're almost guaranteed. Look, they're blowing earnings out the water. Like, geez Louise. Like, is Old Navy in this? Because Old Navy, like, sells their own stuff, So I don't know if Old Navy is considered to be off-price retailers, as opposed to like how I mentioned, TJ Maxx will go out and like wholesale purchase like big bids on retail, and have Nike and have Adidas and Nautica and Polo and all the different brands and different products of the brands, and like they'll have a Nautica suitcase and a Nautica Polo. Like, what's up with it? Like, you know what I mean? Like, so I don't know if Old Navy would be considered in this or not, but maybe like similarly priced items. I don't know. But another sector that really caught my eye that I mentioned to the gang, to the group, to Integral Post, was like, yo, eyewear and optometry has been slowly and quietly killing it. Like, look at this. Like 10% on 11, on 12, on 8, on 12, on 15, on 8, on 12, on 11, on 4, on 5, on 2, on 6. Like, it's not 20 over 20 over 30 over 30 over 38 over, you know what I mean? But it has been quietly killing it for sure, especially compared to the other sectors that have barely a single weekly change over the last year, previous week, to the positive side. Dollar stores are getting hit over their head. They can't even, their margins are compressed over compression, and they're not even really increasing on sales. And then all while that was happening, I'm looking around, I'm like, yo, I'm seeing flow come in, and I'm like, What are they doing over there with Warby? Right? November 12th. If you guys can see this, I don't know if you guys see this, but okay, cool. You can. November 12th, I posted flow. Somebody put a positioning in for December 18th, 25 calls, 1.21 million bet to the upside on Warby while it was at $17. Excuse me? You put $1 million on Warby Parker? Excuse me? Like, is Warby Parker undervalued right now? Like, are we going to see a huge optometry play? Like is LensCrafters a publicly traded company? No, that's Lennar. I don't even know. Sorry, my fault. Right? Like, oh, Exolotica. Yeah, that one. Whatever that one's called. That's the one that's... Oh, it's an OTC? Never mind. OTC just means over the counter. And it's an ADR ticker, meaning it's an international company. So, one, it would be really hard to trade in U.S. markets unless there's enough like shares in the U.S. market in the ADR. ADR just means American Depository Receipt. So when you buy companies like and I do have some assets, some names in Chinese names like Xpeng, names like Guidon, right? Li Auto, JD, Baidu, Alibaba, of course, Tiger, Up Finance, like all these, as you can see right here, they all say at the back of their names, ADR Class A, ADR Class A, ADR Class A, basically, right? That's called an American Depository Receipt. That is effectively the company siphoning off a portion of the shares that they have in the native market and then giving a sliver to the US market to then say, like, hey, there's some liquidity over there. Let's go, like, give them the opportunity to invest in the name as well. So that's basically what that means. And I don't know if a name like Extralotica, I don't even know how to say it, whatever, it's like actually going to benefit from something like how Warby has been able to. And I think Warby has the brand. These frames are Warby. I buy my contacts from Warby. My last 2 glasses have come from Warby. When my mom buys glasses, she goes to Warby. Like, at this point, it's kind of the norm to go to Warby. So when I'm seeing that, when we're seeing data like this optometry growth, week over week over week, over, like, come on. Because guess what? They're not spending anywhere else. They're trying to make sure that they got all the retail that they need, right? And then they're trying to make sure that they got their glasses. A lot of people are coming up on their year end that didn't use their insurance premiums on the year for their optometry. Like myself, I bought these glasses last year, December. I'm about to go spend right now because I need a new frame, because I need to get my eyes tested, right? I'm about to be a part of that category of spending on my optometry. So, and you see names like Warby doing 7% on the day, like, excuse me. It's not just like just because, right? Not only that, you're seeing the open interest of those buys stick. People that are buying the $20 strike for December 18th, looking for it, the open interest is sticking. Meaning they didn't buy it for a day trade. You know what I mean? They didn't buy Warby at 9:45 a.m. when it was trading at 17.26 to sell it $1 higher at 18.26, right? They bought it to hold it. effectively meaning that they genuinely believe in their heart that it will and can appreciate to the $20 mark. And if not to the $20 mark, potentially beyond that within this upcoming month. I'm trying to figure out where are the 2028 huge sweeps. Oscar trade, huge healthcare trade positionings. More and more people are piling into Oscar. It's truly insane. Damn, where's the Warby? Trying to find the Warby 2028 leaps. I'll find them again. Oh, people are. Here's another one. It's not really that big of a leap, but this December, next December, 25 calls on Warby, 1.2 million. Right? And this is a name that's at $2 billion market cap. Like, come on, guys. That's a huge bet. Right? Like somebody like this is also how I view sweeps. When I think of like, oh, $1 million in premium, or oh, $3 million in premium, like, right? $1 million premium bet on QQQ is huge, right? Especially myself as a small trader, small retail trader. Like, it's huge. But then let's look at the AUM on that. 382 billion. Like, what? This was last week's spreadsheet math on Oracle. Let's do this week's spreadsheet math. On QQQ, 382.99, and this is in billions. Right? And then this one is on Warby, right? And then maybe let's find some other spreads. This guy probably put, okay, BE, Bloom Energy. I like that name as well. That name's been on my radar for quite some time. This is maybe where I want to go bottom picking. So now let's go look at those market caps. Warby's. Oh, not the Class A. This one, just the 2.23 billion. Bloom Energy is a 21.28. And then silver, another that's a Goliath. 24 billion. At least the ETF, right? 24.94 billion. So the way I view it sometimes is when these big bids come in, and I'm saying to myself, like, okay, 1.3 on Qs, 1.3 million, by the way, and at 1.2 million on Warby. Let me see. iPad is about to die. Okay. Then we're seeing sweeps of BE coming at 2.1 million. And then, and then silver coming in at 1.3, 1.5. Let's take the bigger one. Let's just, for shits and giggles, right? So if we take that one, to convert these millions into billions, we need to, divide it by 100? No, 1,000. Yeah, you got to divide it by 1,000. So we take oops. Was it 2.1? Yeah. So that's how much in billions, right? Sweeps, when we see the sweep orders, sweeps in millions. And that's how much in billions, right? That these market caps are in, right? And now let's see this divided by this. And then let's just look at that as maybe a percent, right? So boom, perfect example. Look at this. This 1.2 million is, yes, nominally less than the Bloom Energy sweep, nominally less than the silver sweep, than the QQQ sweep, right? But these market caps, in billions, right? And these sweeps in billions as well show to be a higher percentage of total market cap. Meaning that this one sweep is meaningfully more to this specific underlying asset of Warby Parker than it is if that same sweep, if that same $1.2 million was going to be put towards QQQ. And granted, it's still a lot less. This is not even a 1% move of the total market cap, right? But it is control of, let's see, how much? 4,000. Okay. So this particular Warby sweep was 4,000 contracts of Warby and 100 contracts each. Each contract, we know that. So it's effectively in control of 40,000 shares, 400,000 shares, sorry. 400,000 shares. So if he were to have just bought the 400,000 shares at 17.55, which is what we've got listed here, right? It would have costed him $7 million. $7 million to get that same exposure. He paid $1.2 million to get the same exposure of $7 million. So sometimes you got to think about that. In that case, shape, or form, right? So now if I were to say 7 million in the case of billions, right? And it's not the same, definitely not the same. But let's just take a look at that. 7 million, divided by the 1,000 now? Right? Is that right? 7 million, yeah, divided by the 1,000. Okay, cool. And then this piece, then now divided by the market cap of E7. Yeah. Is that right? I guess so. $17.5. That'll be my fault. I multiplied by 1,000. Oops. Yeah, right? That's right. 7. Yeah. Divided by 1,000. 7 million. Yeah, divided by 1,000 is 7,000. That's interesting. So now that 7 million comes into being way higher. But that's not right though. There's no way that's right. It's doing its own thing. It's being weird. It's like 7.02. There, that's what we gotta do. Okay. So 7.02, and then now divide that by 1,000. There we go. I don't know why the numbers just being a bit weird. 0.72, and then now take that number and then divide that now by that. Oh no, oops, that's not the market cap, that's the sweep by the market cap, which we have here at 2. So then boom. So that's now, that goes from a 0.5, from a 5 basis point coverage of the market cap to effectively a 31 basis point coverage of the market cap. A much, much larger position if he were to go out and just buy the shares. But he's effectively buying, like in the way of how you can visualize leverage at times. This is a great example of that. He used 1.2 million to effectively use 5 basis points of the underlying asset's market cap to garner the buying power of 31 basis points of Warby Parker's market cap. He leveraged 1.2 million to have control of 7 million. And that's how the market works. Which is way, way more than if he would use that same million for Bloom Energy, for Silver's ETF, or even QQQ, because QQQ is so huge that like even that $1 million sweep does nothing. Like you have to expand this out so far. There we go, to now get a number. And same thing for these guys. I gotta expand these out a pretty decent amount just to get a number. So I think futures are open right now. I also think the market is pretty open right now. In the sense of just like the overall market updates. Here we go. What we're seeing, I honestly may need to step into this Warby trade myself. I'm adding Warby to the watch list because it just makes too much sense. The data is there telling us the story. Why would I not listen to the story that's being told with the data? So I'm going to do that. removing some names off the watch list as well. SanDisk was an insane short that I was not able to actually capitalize on. Very brutal name. It's gonna haunt me. It's gonna annoy me. I'll leave it at that. But I basically drew this whole plan out, gave it to the Discord, gave it to the server, and then didn't take it fully myself. So like if I, when did I outline this? I gave new position on the 18th. New position here, guys. SanDisk 116, 200 puts. The contagion will spread deeper into the better names as well. Investors have no cash. Bank of America told us it's at 3.7, right? So my idea was that they were going to cut some of their winners, and even some of the winners that were fully extended into the like names that have had great weeks, great months, right? That they're going to start to see a little bit of a cutback too, especially if we get deeper and deeper into this pullback. The contagion will spread from just the top names that they've trimmed from into names that they maybe wanted to hold on to a bit longer to. And that just crushed me. That just crushed me. I started to see a little bit more puts on them as well. In that case, I was like, all right, cool. I am still a bull on SanDisk, right? But that trade just made too much sense, at least for the time being, for the upcoming week, upcoming 2 weeks. And I drew out this plan for it. This is the plan for it. And this is what it did. What is that, daily chart? All right. That was the plan for it. The plan was, hey, we're doing really good up here, but as time goes on, as we continue to see all this volatility, all this question mark, all these issues, we can very well see a pullback into the 200 range, which is where the real last base was that we saw. And we went exactly there in a day on that Thursday, the Thursday reversal. It was systematic selling. It was all of it in one trade. And I was entry short here at 251.11. That's where the yellow line's there. And I just didn't hold it. I did not hold it. It is what it is. I'll try and move on from that, but that's about it. It just sucks because it literally did it in a single day. A single 22% in a single day. Like, are you mad? Are you mad? On the 20th, after saying, hey, I was live here on the 18th, 2 days earlier. I'm still live an hour later, even though it went against me originally. This also didn't look good on the following day. It's continued to hold while everything else sold off. Then I'm giving out position updates. I'm like, oh, wow, it's actually moving lower. It looks great. Like, we're at 242 now. And I cut it. I cut it. Whatever. That's enough of that. So, I mean, it looks like some of these other commodities, let's kind of see what's going on. Commodities. Bond futures, kind of going long a little bit. I don't even know what this is. KTB futures. I don't know what that is. I don't know what that means. The China 10-year bonds, flat on the long side, flat on the short side over this past week. Gold futures saw basically flat as well. not much movement. Oil futures, nothing interesting there. Long exposure collapsed on aluminum. What else we see? Copper, kind of flat too. Nothing super sticking out to me. Right? Like, okay, what's this one? Soybean meal. I don't understand soy enough to be able to trade that. I'm going to just leave that there. These are in currencies. If anybody here is into currencies, here's some of the positioning. Euro USD, GBP USD, Australian dollar versus USD, USD versus Japanese yen. That's something super interesting with what's going on in the Japanese yen right now because of the what's going on in that bond market over there. Oh man, the bond market that like basically all time highs. I think they're 10 years at 32%, something like that. Right now, that's a problem within itself over there. Some of that contagion can find itself over here, but I do believe that the yen carry trade did kind of show us that as well. So leverage and inverse ETFs as well. Our analysis indicates that US-based ETFs currently could be responsible for their approximate 942 and 2.2 billion in S&P and Nasdaq 100 buying and selling, respectively. Per 1% move up or down in the underlying index, this could equate to a 3% and 21% average notional S&P and Nasdaq futures that was traded between 3:55 and 4 p.m. over the last month. Notably, the amount of the S&P and Nasdaq that leverage the inverse ETFs would theoretically need to trade for each 1% move decrease with spot this week. That's pretty huge news. Like what? Huge flow. Right? Because these leveraged ETFs have to be bought. Like, for example, as there's more buying and selling in these ETFs, it accelerates the buying and selling in the actuality, right? So when you see these leveraged ETFs, these, what is it? SQQQ is one, or TQQQ is the ProShares one, right? They have to then go buy and sell as well for it. This is a November 10th report, not anything new, so don't want to really put that in there too much. Right, Tesla flow from leverage and inverse ETF per 1% move, like decreased. Leverage lightly decreased. Like these names have to go sell it to be able to rebalance and have the right amount of what they're staying with in total asset under management. So basically what they're saying is, hey, as the underlying asset, as QQQ is down 7%, some of these names have to be down like even more, right? Look at this. These guys are down 21%, while regular QQQ is down 7%. And these assets, how much is this? 26 billion? This 26 billion, a piece of this 26 billion, a fat majority of this 26 billion is, okay, so 55% of this 26 billion is QQQ holdings that allow you to give 3x exposure over a one-day holding period for the Nasdaq 100 stocks. So each day they have to go out and sell systematically to be able to cover all of the net buying and selling as well. It's insane. It's insane. I think that's pretty much it for like macro minute and like vol and inverse and ETFs and really data heavy stuff right now. Um, I guess I can kind of get into individual names, or let's go look at futures right now. Futures right now, 55 basis points, cool. Like, kind of whatever. But I do think, like, it's up, right? But like, again, what did I say last time? What did I say last time? Hold on, let me see. Monday. We opened last Monday when I was on stream and I was like, oh, we're up. Like what? 20 basis points, 70 basis points? Like, what does that mean? Absolutely nothing. Because what happened that day? We closed the whole percentage point down on NASDAQ. Doesn't mean anything, bro. These gap ups, the whole like Robinhood giving you notifications that, oh, your stock is up 7% pre-market. It doesn't mean anything for real. For real. Does it mean anything? Like, not really. Sometimes it does. I'm not saying it never means anything. But a lot of these names go 2-3% in the pre-market in the overnight session just to give it a back. It's very thin trading. For example, if I were to say, hey, oh, my fault. If I were to say these sunglasses are really it, right? And this is what I mean when I say thin trading in general. Wait, let me check. Can y'all see me? Oh, snap. Have y'all been able to see this? Y'all just been staring at me? Oh, no. Hold on. Darn. I'm sorry if y'all haven't been able to see me or see recently. I'm just taking a look at futures to see what's going on. But, okay. So when I say thin trading is going on, or when I'm referencing GEX or Gamma or all these other bits and pieces of what's going on, basically means like just because price jumped in these pre-market sessions or these other things, it does not mean that that's the consensus of what price is, right? So let me explain. In these pre-market sessions, in these overnight sessions, the volume is dramatically decreased. A lot of these algos aren't turned on. The everyday person like you and I aren't buying in these names. A lot of retail and a lot of some of these firms don't have their machines on, right? Basically meaning there's a small subsection of market makers and people that are in the markets at that time that are trying to make a bid, trying to make a market out of low liquidity, out of less people present in the market willing and buying to buy and sell, or willing and able to buy and sell, right? So what happens is it creates these thin trades where price moves, but they're thin. It's not built on concrete and brick and mortar and heavy layers and insulation. It's built on one thing to another, right? So I'll say this. If I take this glasses, right? I take these glasses and I'm like, yo, these glasses, these are it right now. They're in fashion, you know what I mean? Everybody's lit. Like, if you got to get a pair of these, like, whatever this, like, brown, I don't know what this, like, maybe colorway, is that the right term? Or I don't know. I don't know what this is about, like the cheetah print, cheetah girls, whatever, like, kind of like this, like, speckled brown kind of thing, right? This is it. Cool. And I say, yo, these glasses are worth $10 now. That's awesome. They were worth $10 yesterday too, right? Like just glasses. Now all of a sudden, everybody liking the color, like this, the whole brown and like the whole spotted. It's real. It's real cool. And I don't, when I say not everybody, but a good portion of people, right? Let's say I go out in New York and I'm walking around and somebody's like, "Oh, you got those glasses, yo," right? And he's like, "Yo, I'll give you $20 right now for those glasses." And I'm like, "Pardon me? Sure. I could go buy 2 more of these tomorrow, right?" That's essentially what happens in pre-market trading. So in this case, if this glasses was a stock, it's $10. One person buys it for 20. Now it's up 100%. Or maybe not even just one person. Maybe in a maybe a more like practical case, a few hundred people bought it for $20, right? Because they viewed it at $100. They viewed it at 100% higher, $20, right? A few people bought it, a few hundred people. Is a few hundred people a good sample size of the entire stock market? To say that we have confirmed a price of $20, that this glasses is worth to be $20 now instead of 10 yesterday? No, it's thin market trading. That's what I mean by when I say that. There's only a few sub-selection of people that are willing and out there to spend well above asking price just to have this glasses. And that's maybe because they don't value $20 the same as somebody else does. Or they don't value the underlying asset, in this case, as somebody else does, right? So when pre-market trading comes about and you see, oh, wow, this is up 20%, this is up 7% because of this or whatever. Okay. But when the majority of the market steps in and they really say this is a price and they really say this is what we are agreeing on, that is when I'm saying, okay, the market is agreeing that this is some type of price. This is a valuable price of this asset. Because otherwise, it's built on thin trading. It's built on 10 people saying, yeah, sure, it's worth 20% higher. Right? The same way how I could probably stack this water bottle up and put this glasses case on it, right? And it says, oh, it's worth 10% higher. It's worth 10% higher. And then when the real volume kicks in, when the actual market kicks in and it opens up and says, hey, this is how much it's worth, the glasses fall off a cliff because there's nothing there to hold it. The 200 people are no longer the majority. They become the minority of the people that want to buy and hold and have this asset for a long period of time. They become the minority. So in that case, the people that are up here like, oh, let's take it down lower. It's not, this guy's somewhere $20. Yesterday they closed at 10. How are they worth a whole 100? No, get out of here. At most, worth 5% higher. Right? So you see these names, break news, and that's literally the reason why a lot of these companies stop their trading or they halt their trading before an announcement. Or that's literally the reason why we have earnings after hours or before market hours. So that the volatility in the total number of people that are stepping in and saying all this stuff isn't actually changing the market. We don't see real time what's happening in the market, right? Like we don't see it. We only see a small subsection of what's actually happening in the market, right? So, yeah, that coupled with what we're seeing now in some of these, and some of the crazier names in the R3000, the Russell 3000 stocks, these smaller and mid-cap companies that went bonkers from August into mid-October, right? You see them getting beat over the head as of late. Beat over the head, right? And it's good in a way to see that this is happening. This rents is happening. This this kind of like market-wide austerity has come about, and we've kind of seen like, okay, calm down now. You have no revenue. You have no revenue. Relax. And that's kind of what I was leaning into earlier when I was saying like, hey, like, we gotta try to see where the momentum's going. So these pockets of momentum chasing have reversed dramatically. The momentum chasing that we saw that directly correlates with these names has gone to dust. No momentum chasing right now. Like basically, So if you're in it for momentum right now, it's not really going to work. At least not on your side of the fence. Unless you're making some adjustments, like you're maybe you're momentum chasing into stronger sectors, healthcare, as I mentioned before earlier, things like that, right? Rolling 1 week retail net demand, Russell 2000, the smaller cap names, demand has dramatically decreased, fallen off a cliff. You heard? Data from Morgan Stanley, quantitative trading desk, or quant desk, right? What else? That's gamma stuff, gamma flow, right? As of late, let's see what else. Let's see what else I can share with you all. Where are we at? 1:45? Cool. Positioning in tech has dropped, but that in cyclicals, which was already much lower, has dropped as well dramatically, according to some Z-scores. That's interesting. I can show you guys that real quick. CTA exposures. I think we kind of see some. I honestly think we see some chop this week. Aside from super specific names that are within strong sectors, like I outlined with Warby, like I outlined with Merck. I think we see a lot of chop this week while the market tries to decide if we want to go higher or if we are going to stay, in this lower positioning, right? Like, and I think that's super important to keep a lookout for as well. So it's so crazy. Like, yes, we're in a correction, but like, what is 7%? Like, it's just because it happened in a month that has made it seem like so much more dramatic than what it actually is. Or because it happened in such volatile fashion. Like, we were down crazy, and then the video earnings came out Wednesday after close. We were up 450 billion in total market cap, and then we wiped all that out by like the following noon, or like the following like 2-3 p.m. So we were crushing it. NVIDIA earnings, whoa, we're back, we're so back, sound the alarm, 450 billion in total market cap added, boom, boom, crushed again by the following noon, by the following 2 p.m. Like the money doesn't exist in a way. So I thought that was pretty insane. Let me add some quick data points to some of my market updates here for us all. And then we'll get into it and we'll kind of wrap it up from here, eh? And some positioning, some more data stuff. Very data heavy with a lot of my trading. As you guys know, a lot of times I'm not making a position until the data says so or suggests so. So I'd rather be super early to the party or relatively late because the data has to show me what's going on in the first place for me to agree, for me to see that this is what's actually occurring, for me to jump in on it. So a lot of these data points are put together by what is it? You got by people like Morgan Stanley, Deutsche Bank, Bloomberg, SEC filings, Bank of America. As you've seen, all these reports are the aggregate of that, right? And I'm not always the person putting these data points together, but I'm definitely a reader of these data points, someone who takes them into full, deep discussion and actually like holds high weight, high regard to them as well. So whoa. All right, so cool. All right, so what I'm seeing here next week, S&P implied move for the U.S. holiday week is about 2% implied move. That means that the volatility is basically saying that we're going to move 2%, whether it's up or down. I don't know. Some macro things that are going to come out is home prices for September on Tuesday. Whatever. I don't really know if that's going to spark something in housing or not. I'm not really too tied to housing. Haven't also like spent time looking into it as well. I probably should, assuming that I want to buy something. But I mean, at least just as of recent, the market hasn't given me much of an inkling of interest. Beige book comes out on Wednesday. Earnings on Monday. We got Zoom, I guess, for all that matter. I mean, honestly, I didn't care about Zoom until COVID came out. I mean, until COVID stopped becoming a factor. Until COVID became a non-factor, basically. I see Baba here. That's interesting. You got Best Buy, too. Huh? Shout out to my old employer, Best Buy. You know what I mean? Y'all held it down for what it was. Kohl's, okay. Kohl's. I wonder if Kohl's is considered to be a non-retail, right? Remember we were talking about that earlier? Analog devices, what's this? Like a tech? Oops. Semiconductor tech? Okay. Dick's Sporting Goods, okay. More retail. Listen, Dick's been buying up everything. I heard they bought Foot Locker too, bro. Like, damn. Also Tuesday we got Dell. Honestly, I think those are the biggest earnings coming up this week is Baba, Dell, and probably Workday. And Deere. Oh yeah, and Deere. Dell got hit over the head too. Basically right back at that entry when I played it back at 120. Should I drop it on the watch list? Nadir. Industrials, look at that. Just been curling up the whole time. Slow moving, slow burn, but it's been burning, you know? Okay, so let's see what it's saying right here. SPX only down less than 2% on the week and 4% off the highs, roughly. Probably thanks to that Friday bounce, sparked by Fed Williams' dovish comments for a near-term rate cut. Right? Putin raised the talk for the end of the war in Ukraine, and Trump team is floating the idea of H-200 sales to China. Market is now pricing in the 65% probability of a December cut versus on Thursday, 37% Fed cut. ETFs are still driving the tape at 40% of the total tape, and S&P top of book liquidity is degrading currently at 2.9 million versus 11.5 million, which is the 1 year average, basically meaning less people are buying, right? 2.9 compared to 11.5. There it is. This dynamic is exacerbating the market move in both directions. That goes back to my example. I'm telling you about thin markets, these thin markets, right? Because what ends up pushing price up, right? Yes, it pushes price up. A lot of the buying, all the selling is what determines price, right? When somebody comes to the market and say, here's the bid, here's the ask, when those two meet, that determines the next price. And then when they meet again, that determines the next price. That's why you see these ticks. When you watch the markets and it goes up, oh, boom, boom, up, boom, boom, down, oh, down, up, down. That determines the next price. Each transaction determines the next price. But when there's less people, right, as you can see, 2.9 to 11.5, millions of dollars being spread in the buying action, we can show that it's thin markets. So as soon as somebody comes in with a $500,000 or $1 million book and says one big buy, price flies. And conversely, somebody comes in with the $1 million book to short it, price drops dramatically. So it's not that these moves are, not real. Yeah, they're real in the sense that somebody's buying it at that price, but we're talking about sustainable prices, right? A lot of these buys, and you see these big jumps up and these big jumps down. It's like, is this sustainable? Like, I don't know. Like, it could be gone in a few seconds. Like, for example, when was this? I think Friday. I'm trying to find it real quick. This one right here, this candle right here, 50 basis points on Qs. That happened. Actually, find it right here. This candle right here, 44 basis points on Qs. That happened at what's that? 1:48 p.m. I literally saw this happen. Headline came through on my terminal. That was Trump team floating the idea of H-200 sales to be allowed in China. That headline broke then, at that exact moment. If I go to Asian chat, let me see. Boom. Boom. You see it. And that exact moment, we flipped bullish. Also, the VIX was already coming down. The volatility was coming down as well. Things were looking good. You know what I mean? Things were looking good. Some people piled on more shorts. And other people focused on what was real. Google. Long-term vision goggles. Focus on your long-term vision goggles. You hear me? Also saw some flow in Datadog. That was pretty cool. Cypher as well. More. But yeah, all real positioning, all real stuff. So on the week, long only funds and hedge funds finished net negative 3 billion and net negative 1 billion net sellers, respectively. Still seeing supply across duration assets in tech. More generally, money is leaving tech and apparently finding a home elsewhere. Come on, guys. They're finding homes elsewhere. So let's find where they're trying to put their money, which it seems like is in healthcare. You know, I have not really done too much in research into healthcare, but I will be there recently. I will be there. I've created a little healthcare list. Most of my healthcare list is kind of degen in a way, as you can see. It's Hims and Oscar and Teladoc and, you know, some of the more questionable companies, right? But I'm gonna find the real ones. I'm gonna do some research on them too. I'll be sure to share those out. For an early look into month-end U.S. pensions are modeled to buy about 13 billion in equities, U.S. equities. The first buy estimate since April 13th, 13 billion ranks in the top 75 percentile amongst all buy and sell estimates in an absolute dollar value. In the past 3 years, it's in the 78 percentile, going back to 2000. So that's pretty cool, right? Long-term money in pensions are in the higher 70, 75th, 78th percentile in buying, right? So a lot of these long-term buys that are coming through, 2026 leaps, 2028 leaps, right? Like, yo, we're in November right now. Those January 2026 leaps are no longer leaps. Lock in, bro. Lock in. Discretionary versus systematic funds and strategies, their positioning continues to plummet. The current percentiles, as you've seen, right? Weighted average Z-scores for positioning indicators. Seems like discretionary investors are a little bit more on the selling side as opposed to the systematic ones, but I think the systematic individuals sold off more just simply because triggers were broken, right? Like S&P, we broke we broke the 660. Qs, we broke the 600. Like those were important numbers for these systematic funds. Potential selling by volume control funds or volatility control funds, right? These vol guys kicked in, and vol became the most important thing last week. I feel like most weeks I talk about the VIX and the VVIX and correlation of that and all those data points, and it doesn't mean anything. I'm in a group chat with some people, and they're like, oh, macro doesn't matter. Macro doesn't matter until it does. So you always watch macro. Always. Oh, we'll just buy the dip, buy the dip. Cool. Buy the dip. Until your emotions get played out into this whole thing, and you're up 40% on a call play, and you're back down to 80, and you're back up again 25, and then you're down 30, and you're back up 100%, and you're like, that meme. What's that meme with the guy in the red shirt with, like, I think he has some braids or something? He's like, yeah, that's how you feel when vol comes in and takes over for real. And then you can't sit in your position long enough because you just feel it weird. You just feel like, I'm wrong, I'm right. I'm wrong, I'm right. I'm a genius, I'm wrong. I'm genius, I'm wrong. Right? Like, and I'm saying this out of experience. That same shit happened to me, bro. Like, I'm not I'm not I'm not, you know, no, I'm not immune. That's the word. I'm not immune to those movements as well. I do set up things to try and help me fight against those movements, right? But like, I'm not immune to it. It still happens to me. Why do you think I didn't bank on Sanders dropping 22% in a single day while I was positioned correctly in the first place? Am I bitter? Yes. Am I mad about it? Yes. Am I going to get over it? Yes, eventually. But yeah. Another thing to take into account, MCG and tech are positioning down a bit, right? But also, so is everything. Defensives, well, maybe not. Let me not say everything, but like the groups of it, right? Defensives are down a bit, and cyclicals, who were already down, are down more, right? Consumer cyclicals, financials, energies, materials. That's that section. Defensive, which is usually utilities, real estate, telecom, healthcare, down a little bit as well, right? And even though healthcare as a whole, that sector was a strong one, it obviously can't hold the entire real estate and the total utilities market and the total telecom market and other sectors as well. So I would say the least change on these three sectors seem to come from the defensive sectors, even though those were still positioned to be down. So I'm very much entering into this week with an I don't know point of view. I'm gonna just wait to see where vol and liquidity and all the other pieces take me, because I don't know. As the tape reversed on Thursday, hedging demand was apparent. We saw a massive bid to puts as volumes remained elevated. Put volume was the third highest year to date, and the total option volume reached one of the highest levels of all time. The chase for downside protection has left us with one of the highest normalized put call skew levels in the last 3 years. Huge. Many thought that post NFP and NVIDIA earnings that we would see a visible shift lower in vol, right? Because those macro risks would have been behind us. There'd have been tailwinds, right? As risk premia is taken out of the curve as well. Risk, right? Same how you play into NVIDIA's risk or any company's earnings call, you pay a little bit more for their premium for the implied volatility of that change. So a lot of times the implied volatility of these underlying assets will change simply because they need to bake in that volatility that can occur. But these market moves get exacerbated by thin liquidity and dealers carrying less gamma support, especially in the downside. All right. So apparently the Goldman Sachs Panic Index logged a 9.61 out of 10, showing extreme stress under the surface. Yikes. That's super interesting though. Let's see, when is this gamma, or when does this panic index usually? I feel like it's always panicked. Like, what's standard deviation? 2.34. I guess I kind of figured it to be more normalized, maybe closer to 7 than like living up here in 10s all year, in the 9s all year. But that's interesting nonetheless. We're in this elevated panic. Maybe that also incorporates like just the violence of all. I'm not entirely sure about that one, that index, but I can watch it to see what's going on. On the systematic front, not only were dealers short gamma on the spot coming into Friday, but CTAs were back dominating client discussions. While this cohort has been selling throughout the week, length remains elevated. They're modeled long about 135 billion versus 180 billion year-to-date highs. And we will really see this group offer supply in a big move down from Thursday's close, where they were sellers of 25 billion in the SPX. So they seem to be off, the strength side of things. And they seem to also be willing to give a little bit more as well, in the sense where they're probably going to contribute to the selling and push it down a little bit more. So, yeah, I mean, I think at this point, it really would be important to maybe take a look into some more healthcare names. I'm a big fan of Warby. I don't have a position in it though, but I may join them on the long-term swing. Maybe something into June, roughly. Maybe like the June 20s, 22, maybe. And I can mark this up right now. This is only for the patient players. Only for the patient players. Don't come on here talking about, oh, that didn't happen. I held it for a week. No. This position is only for the patient players, for real. So 17.5 or even just 17. I think 17 makes more sense. Into price targets of 20. That's a requirement. That's a beautifully rounded number that makes sense, that I think people would love to stick onto. 22. And I'm gonna go a little bit higher into 26 or 25 maybe. We just call it 25. Right, so it's for the patient players out there, you know what I mean? For the patient ones. Right? We're a long base. And this J cup, this J cup could be finally pushing along here. You know what I mean? We're along a base that continually gets respected. This looks really good, really. And over the last times out of this base, we've seen it break well into 27, 28, and break well again into 27, 28. So it doesn't seem unrealistic to ask for it to get to 25 or 22 or 20, It's really just a matter of when. We don't know that time period, but we can build a position around the ability to be able to extract that within a reasonable time period, right? I'm not asking it to go to 22 tomorrow, although it can. Is it likely? Is it highly probable? Probably not. But it can, right? Nothing is impossible in this market. But I kind of like this setup. And I maybe want to be looking into Q2 2026 positioning, or even Q4 2026 30 strike. Get some super cheap. Well, it won't be super cheap because there will be a lot of theta premium in that for it to be a year-old contract or a year to expiry contract. But that's something to keep in mind. I think I'm losing my voice here a bit, guys. But I still like Google Longs. It's the name. They were trading at such a beautiful discount earlier this year. I really wish it could go back to that discount, but it doesn't look like it wants to. And oh well, right? This whole AI bubble thing, really, to be honest, I think it could be boiled down to a few names: Oracle, debt to revenue ratio, and how much debt that they're pulling out with 100 billion in capex, and you know what I mean, like they've already lost all the money that they made or the appreciation they made off the Oracle deal. I mean, off the OpenAI deal. And similarly for CoreWeave, right? CoreWeave is extremely leveraged to try and capitalize on this, right? I don't think like a lot of people are there. Like I think we can narrow down the AI bubble or whatever is like the bubble has been contained to. It's been contained to the highly leveraged names. I think it's contained to those individuals because it's still working and there's still tons of capex going to be spent. But remember, these are the hyperscalers that are spending a ton of money as well, right? And these names have probably the most fortified balance sheets that we've seen ever and cash flows to prove it. So like they can overinvest in this sector and still be fine. They can overinvest in this sector and still be fine to an extent as to where a company like CoreWeave can't overinvest and be fine. Why? Because Google has several other arms to go make tons of money and support that malinvestment or that sector of investment, right? The same way how Google has all this investment in cloud centers and compute and all the space that they need because they have their cloud providers as well to other businesses. So if they go create all this supply to compute, they could also just simply sell it to other businesses, right? That they already have huge commitments with. I believe they signed a deal with Anthropic recently. And other companies as well, right? Like Amazon can commit to this spend because of their e-commerce arm being so strong as it is. These other companies can do that. CoreWeave, I don't believe has the ability to do that because they've leveraged so much on so little revenues and so little diversification of the revenues. And in that same breath, the companies underwriting these deals, Owl, it's private capital companies like Owl, Blue Owl, may be a part of it as well. So if I were to boil down the AI bubble to three names, those are the three names I'm putting it to. Oracle, because of their huge debt to equity debt to revenue, and I'd still say that they're relatively safe, but they're the ones that are probably most exposed from a database point of view, as their valuations have tremendously compressed over just like the past 2-3 weeks now. Like, what is Oracle down? %27 a month. They are in bear territory, y'all. And CoreWeave, based on the fact that their model is like they're not even like actually creating value, they're more so just like liaisoning value, right? They're like, hey, this can go to this, and they're just like the middleman of value with high debt at 41.9% down. Jeez Louise. That IPO, that run to 185 was legendary. But this push back down to pre-IPO prices, this next leg of another 100% decrease, basically down to 35, $30, that'll also be legendary. And then Blue Owl, these companies that are trying to go to market and they're the ones underwriting these types of debt. And mind you, they have other things as well, right? It's not like this is their only business, but I mean, this looks like to me a clear head and shoulders if we were to just look at it from a technical point of view. And I could see Owl back at $10, back at $11, off the fact that some of these deals don't really do too hot. But that's pretty much it. Futures are still basically where they were when we first checked them about an hour ago. Nothing new. Bitcoin, or nothing I want to talk about too. Another thing I want to talk about. My fault, y'all. Bitcoin has been in terms of leading indicators, like the perfection of leading indicators. All October, right? Oh, market's down. I can't believe Bitcoin. What? We touched all-time highs, got rejected all-time highs. Now we're at 108. Oh my God, Bitcoin. Oh my God. End of November. Beginning of November. Oh my God, we're about to crack 100,000. We crack 100,000 really quickly, really briefly. Boom. Now we're down here at 86, y'all boys. All that happened in October into this month. Now, if we look at the NASDAQ, what happened in October? At the end of October, we were still on an upward trend. And then now, only in November did we see this push down, right? So that was S&P. This is NASDAQ. Only in November, really, did we see the push down. So Bitcoin continues to be the leading indicator of liquidity and where the risk on markets can go. So if I were you, I'd be watching Bitcoin to see if we make new lows, because this usually tells us, where we're going, right? Further and further down the risk curve, or up the risk curve in this case, with assets like Bitcoin, and then like, look, I wonder if, let me check. What are these like altcoins? Like, what does Doge look like? When did Doge peak? Yeah, whatever. Get out of here. September, y'all. September, y'all. You know what I mean? So like when these alts and these other like, oh, the alternative, like we're gonna take over the world, like assets begin to peak even further. Yeah, look at this huge stop out. That link did not work at all, boys. They peaked August, September, right? So you can see how the domino falls. Pith got a huge spike off the fact that they were going to do NFP data, whatever. Cool. Oh, good to know. Boom. Cardano cracked. All these names cracked. Let's look at the majors. ETH, September, ETH peaked. Solana back at 130. Ooh, excuse me. Solana back at 130 looks beautiful in a way as well. XRP back at $2. Insane. Still can't believe it wicked down to 1.4. Insane. Right? But if you look along the risk curve, if we were to just look along the risk curve, right? You look at what gets treated first. It goes crypto alts. They peaked first. And then crypto majors. Then, after that, started to lead into equities. Like, where are we? Right? The path of liquidity. And that's where you can get a heads up on what's going on. Like, what is actually going on. But I think I'm about done. That's it from the me agent. What? That's it from me, agent. Yeah, probably a little bit. Agent out. Talk to you soon. Make sure you watch your pendulums. Make sure you focus on data. All that chitter chatter, bigger backer, doesn't matter. Focus on data. Peace, y'all.